Hey everybody, how's it going? Derek Nelson here. I want to talk about something that comes up quite a bit when I'm working with people, and that is when it comes to my home and my mortgage. Do I want to pay that mortgage off early, or should I just stay with the 30-year note? Do I refinance to a 15-year note? So I want to go over a scenario where I have a 40-year-old male, father, husband, the whole nine. But this particular individual is a 40-year-old male. He's in good health. And let's see what the scenario looks like. Before I get into that, I just want to talk about the significance of home ownership when it comes to, in relation to actual retirement planning. Because for most retirees, the home becomes the biggest asset. Okay. And it does provide for some housing stability and some equity growth. So, and when I say housing stability, what I'm talking about is as you're going through life, if you have a mortgage, and let's say that mortgage is $2,000 a month, it's always going to be $2,000 a month, whether if assuming you're in a 30-year fixed, whether you're in year 5, year 12, year 18, it doesn't really matter. The only thing that could change on you is insurance and taxes. The actual mortgage remains level. Okay. Then you also, over time, your house value should be going up. So you'll create some more equity within that home. Now, it can also be a source of retirement income. So when you're retired, some people, what they do in an effort to create more income is something like a reverse mortgage. So that's always an option. The other thing people do quite often is downsize. Okay, if you're in a four-bedroom house and now you're 72 years old and there's no kids in the house and you want to downsize to a three-bedroom, let's say, and your house is worth X and the downsize is worth Y, and you take the difference, and now you have some extra cash flow for yourself. And also, having a home is an emotional value. It's not just a financial decision, right? So it does give you some peace of mind. Now, there are pros to paying off this loan early. Number one, you have no monthly mortgage payment. Okay. Now, for a retiree on a fixed income, that could be massive. Okay. You also have some peace of mind, meaning you own that home free and clear. Okay? No one is going to come after you for not making a mortgage payment. Just make sure you pay your taxes and your property taxes and insurance and stuff. So nothing does happen to you. You save on interest expenses. And then, of course, if you free up, if your mortgage is paid off, you're going to have more flexible cash flow in retirement. Now, there are some cons to paying off the mortgage early. First and foremost, you're going to tie up liquid assets. Okay, meaning if you're sending extra money to the lender, if you're sending extra payments to the lender, or if you're in a 15-year note, your payments will be higher. So that money otherwise could be used as an emergency fund, okay, or saving for retirement, right? And by saving versus paying off the mortgage early, you may be able to get some returns there. Your mortgage interest may still be tax deductible, which obviously, if you don't have a mortgage, then there's no tax deduction. And then, of course, paying off the mortgage has no effect on the actual home value. So whether you have 10% equity or 100% equity in your home, the value is what the value is. Now, let's compare what a 15 and a 30-year mortgage looks like. Mortgage one is a 30-year, mortgage two is a 15-year. $400,000 loan balance. You can see the interest rate on a 15-year is slightly lower. But what does that do? Well, mortgage one is the 30-year note. The monthly payment on that is $2,597. The monthly payment on the 15-year note is $3,352. That's a difference of $755 a month out of pocket. The biggest benefit, of course, to that, if you go down to mortgage one and look at the bottom, you don't have to pay 174,000 plus in additional interest. But there are some questions to ask before paying it off early. Okay. If you have a ton of debt, should you be sending extra payments to the lender to pay your mortgage off, or should you focus on paying that debt down? Do you have limited emergency savings? So if something comes up unexpected, appliance craps out on you, you need a new car all of a sudden, are you going to go further into debt to take care of that at the expense of having the mortgage paid? Okay. Are you saving enough for retirement? I'm not a believer in just paying down debt. at the expense of not having enough saved for retirement. Okay. Is your mortgage below 4%? 4% is kind of arbitrary, but point is, if you have a very low interest rate, maybe it doesn't make sense to pay it off early. How would this affect your liquidity? Again, do you have cash flow if you're sending extra payments to the lender? And are you in track with income and tax planning? Okay. These are things that you really need to consider, especially on the income side. What's your income going to look like in retirement? Okay. And also, what if? There's always what ifs in life. And, what if you become seriously ill, namely the big three: heart attack, stroke, cancer? Maybe you require months of treatments or months of rehabilitation, and now you're not producing a paycheck. What happens? Can you afford to stay in your home? What happens if you can't work for a year? Okay. And if you don't have the proper amount of savings and all your money's tied up in your home in the form of equity, well, heck, banks like to foreclose a lot faster on homes with equity than don't have equity. And the same rule applies if, what if you become seriously injured? You could be hit by an auto vehicle, you could fall and hit your head. Anything could happen, right? There's 6 million ways for us to get hurt. And what happens if those injuries are extended and you can't work? Same scenario, right? What if you suffer a job loss and you're not producing a paycheck? Or number four, a big question mark: what if something happens that we're not thinking of right now? So what I wanted to do is I wanted to just kind of talk about an alternative to a 15-year mortgage, or sending extra payments to the lender. And just know that you can stay with the 30-year note. And the difference in this scenario, that $755 that you would have been allocating should you had a 15-year note, you can actually save in something that protects and grows. And what is that exactly? Well, it could be a cash value life plan. And the reason I talk about that, in particular, a whole life plan, was number one, it has guaranteed growth. You earn interest and dividends. You can never lose money, regardless of what the economy and the stock markets are doing. Okay. If you have an emergency, if you become sick or injured, you have access to the cash funds if you need those. Okay. You don't have to apply, you don't have to get approved. You simply put in a request and gives you complete access to the cash value that's within the policy. Okay. This keeps you in control, right, of your life. And then, of course, it's self-completing. What the heck is self-completing? Well, it's simple. If you pass away, there's a tax-free death benefit that your loved ones could use to pay off the mortgage so they'd be able to maintain their lifestyle and stay in the home. Or if you become fully disabled, there's an optional rider called waiver of premium that will continue to make those monthly payments for you should you not be able to do those yourself. So let's look at it real quick. So this is year 30 of cash value life insurance policy, a whole life policy. This person elected at age 40, when they took out their mortgage, rather than going to a 15-year mortgage, they stuck with the 30-year mortgage, and they allocated the $755 a month into their cash value life insurance plan. In the 30th year, they are done paying their mortgage, and that $755 a month they did over 30 years now equated to over $500,000 in tax-free cash value. They can use this money to help with their retirement income. Also, here's another scenario. If you are still looking to pay your mortgage off, this is the flexibility of whole life. If you look in year 20 in this particular scenario, on the left, you have year 20, so the year's 2044, you owe $226,000 and change to your mortgage. Shift over to the right in year 20, at 60 years old, you have $267,000 in cash value. You could take the 226 out of your life insurance policy, pay off your mortgage, have that mortgage free and clear. And you still have the life insurance policy, and that loan that you took out on the policy, you can choose whether or not you want to pay that back. Okay. Now, I just want to let everybody know this is one very in particular situation. But if you want to learn more and you want to reach out to me, I'm happy to have a conversation that would help tailor any recommendation to fit your particular needs. Here's my information. That's my cell phone. That's my email and website. And of course, in the content part of this video, I will also include my link tree so we can connect on social. Okay. Well, anyway, I hope you're having a great day, and I will talk to you soon. Take care.